Have you ever wondered how auditing has evolved over time? This video delves into the history and ethics of auditing, from its inception to the present day. Discover the key milestones and ethical considerations that shape modern auditing practices. Auditing is the systematic examination of financial records. It ensures accuracy and compliance with regulations. Auditors assess financial statements to provide stakeholders with confidence. They help detect fraud and errors in financial reporting. Auditing is crucial for maintaining trust in financial markets. Before 1840, auditing was informal and inconsistent. Financial records were checked by owners or trusted individuals. There were no standard procedures in place. This lack of structure often led to errors and fraud. The need for formal auditing processes became evident. Correct? This is a main call out for this scene. It brings into focus the core idea being discussed. From 1840 to 1920, auditing began to formalize. The Industrial Revolution increased the complexity of businesses. Auditors were employed to ensure financial accuracy. Standardized practices started to emerge. This period laid the groundwork for modern auditing. This era marked a turning point in auditing practices. From 1960 to 1990, auditing continued to evolve. The rise of multinational corporations increased auditing complexity. New regulations and standards were implemented globally. Auditors had to adapt to changing business environments. This period emphasized the importance of ethics in auditing. Since 1990, auditing has become more sophisticated. Digital technology transformed auditing processes. The focus on transparency and accountability increased. Auditors now use advanced tools for data analysis. Ethical considerations remain at the forefront of auditing practices. Ethics in auditing is about guiding behavior with moral principles. Ethical values determine what is considered right or wrong. Businesses are morally accountable for their actions. Auditors ensure that companies adhere to ethical standards. Ethics is integral to maintaining trust in financial reporting. Auditors face several threats to independence. Self-interest can arise from financial interests. Advocacy occurs when promoting a position compromises objectivity. Familiarity with clients may lead to biased judgments. Intimidation can deter auditors from acting objectively. The self-interest threat arises from financial interests. It can compromise an auditor's objectivity. Auditors must avoid situations where personal gain is involved. This threat can also extend to family members. Maintaining independence is crucial for unbiased auditing. The advocacy threat occurs when auditors promote a position. This can compromise their objectivity. Auditors must remain neutral and unbiased. Promoting a client's interests can lead to conflicts. This threat challenges the integrity of the auditing process. The self-review threat arises when auditors review their own work. This compromises their objectivity. Auditors must avoid auditing tasks they previously handled. Re-evaluating past judgments can lead to conflicts. Independence is key to maintaining trust in audits. The familiarity threat occurs due to close relationships. Auditors may become sympathetic to clients' interests. This can lead to biased judgments. Maintaining professional distance is crucial. Auditors must ensure impartiality in their evaluations. The intimidation threat arises from perceived or actual threats. Auditors may feel pressured to alter their findings. This can compromise their objectivity. Auditors must resist external pressures. Upholding integrity is essential for credible audits. The conceptual framework guides auditors in problem solving. It involves identifying and evaluating threats. Safeguards are applied to mitigate these threats. If safeguards are ineffective, auditors may decline engagements. This framework ensures ethical and objective auditing. Identifying threats is the first step in the framework. Auditors must recognize potential risks to independence. This involves understanding the client's environment. Identifying threats allows for proactive mitigation. It is crucial for maintaining audit integrity. Evaluating threats involves assessing their significance. Auditors determine the impact on their objectivity. This step requires careful analysis and judgment. Evaluating threats helps prioritize mitigation efforts. It is essential for effective audit planning. Safeguards are measures to reduce threats. They protect auditors' independence and objectivity. Safeguards include policies, procedures, and controls. Applying them ensures ethical compliance. Auditors must tailor safeguards to specific situations. If safeguards fail, auditors must take action. They may decline or discontinue engagements. Resigning is an option if independence is compromised. This step protects the integrity of the audit. Auditors must prioritize ethical standards. In conclusion, understanding historic and current auditing processes and procedures is fundamental to ensuring transparency, accountability, and trust in financial reporting. By exploring how auditing has evolved over time, professionals can appreciate the importance of regulatory standards, ethical practices, and technological advancements in shaping modern audit methods. A strong understanding of both traditional and contemporary auditing approaches enables auditors to conduct thorough, accurate, and compliant assessments. This knowledge not only strengthens organizational governance, but also upholds stakeholder confidence and the integrity of financial information. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07,484,361,688.